First of all, there's two themes in The Wizard of Oz. One is and everybody in the U.S., of course, is familiar with this story. It's the most popular American fairy tale.
In the UK, we watch that as well. Yeah, I'm sure most people watching this video have seen that. And was that really about debt and banking?
Yeah, well, it was prompted by, there was a money reform movement of the 1890s, and the first movement was a greenbacker movement. So there was this rather remarkable newsworthy event where there was the first ever march on Washington. They marched all the way from Ohio to Washington, D.C., and the man who led it, his plan was to go back to the greenback system of Abraham Lincoln, where the government...
Let's take a step back. So greenback, what's the greenback system?
Yeah, okay, so that would be money issued by the government.
Okay.
Directly, as opposed to a bank.
Let's return to this, and let's go start at the beginning. What is actually wrong with banking, in your opinion, which may differ from mainstream economists?
Okay. Virtually all of our money is created by banks,
right,
in the form of, in the 19th century, it was in the form of banknotes. And so they were allegedly backed by gold. In other words, you could take your banknote to the bank and get gold for it at any time. And so the banknote was really just a receipt from the bank. Most people didn't want to carry around gold. It was unsafe and it was heavy. So they liked these little banknotes. But what the banks early on discovered was that they could issue 10 times as many banknotes as they had gold, because most people wouldn't come for their gold. And then, so 90% of these banknotes were counterfeit. I mean, they really weren't backed by gold. The bank didn't really have the gold.
And were they allowed to do that?
They were, because it worked, that you actually needed an expandable money supply if you had only gold. In fact, it was the Italian bankers who discovered that all the way back, I think, in the 11th century or so, that there was a demand for credit. The merchants needed credit so they could go off in their ships, and they would go off with their wares and they would come back with the gold. So they needed some way of extending credit to expand the money supply beyond the actual gold that they had. And because of this credit system, the Italian merchants took off. The whole economy took off.
So you're saying back then, when they were creating this credit, that was actually, in fact, an increase in the total money supply. They were creating money.
Yeah.
Okay. And so, what's that evolved to?
So now basically all money is created by banks in the form of, it was banknotes, and then in 1913 the Federal Reserve took over in the U.S. and printed Federal Reserve notes, which were supposedly the national money supply, but they were issued by a largely private institution. The Federal Reserve is composed of 12 Federal Reserve branches, all of which are privately owned, 100% privately owned by the banks that make up the members of that particular branch. Okay,
so right now, in today's day, this system has evolved from originally private banks creating banknotes to now the Federal Reserve or the Bank of England or the central bank, depending which country you're from, and depending how their system works, to them creating the banknotes. And this is exactly what we have in our wallet as money today, those Federal Reserve notes?
Yes, and very little of our money is actually in our wallets or purses. It's mostly on a computer screen.
Sure.
And that's all created by banks. Yeah.
Okay, so that's not created by the Federal Reserve, you're saying?
Right, not even by the Federal Reserve, yeah.
Okay.
The Federal Reserve itself is suspect in the sense that it's not really a government agency.
Yeah.
But they don't even create most of our money. The banks create it. Just every time that you go to a bank to take out a loan, the bank, people think they're lending their deposits, but really they just create bank credit and write that into the account of the borrower. And then when the borrower writes a check on the account, then the check has to clear, and that's where the deposits come in. So they do need the deposits, and that's why this recent banking crisis was a liquidity crisis. They couldn't get the deposits from the other banks, which is where they get them if they don't have enough. But they start out extending bank credit. I mean, here's the way a bank creates credit, even though all the checks have to clear. Let's say that one bank creates a $1,000 loan, or $1,000 account, which is borrowed by the borrower, and that becomes a $1,000 check, which goes into Bank B. Now Bank A has a shortage of $1,000 in bank reserves, and Bank A has an excess of $1,000. So now Bank B. So Bank A can borrow back from Bank B the $1,000 they just created and clear the check. So you still need the deposits, and you still have the checks, or all the checks clearing, but Bank A just created that money, lent it or borrowed it back at 0.2%, which is currently the Fed funds rate, and lent it at 5%. So that's where the bank gets this nice spread of nearly 5% for money they created themselves and borrowed back.
Okay, there was a lot in what you just said, I think. So am I correct in summarizing something? There's actually two forms of money. There's the money that the Federal Reserve would, let's take the US example, the Federal Reserve would create. And then there's money which is what we see on our online banking, which is, I guess, digital money.
Mm-hmm. There are three forms of credit.
Three forms, okay. So what's the third
Well,
form?
you might even say four forms. The government issues coins, and that's the only thing the government issues. And that goes all the way back to when the government used to be in charge of coining money. Mm-hmm. So coins make up, in the U.S., $1 billion is all the coinage. So that's all that the U.S. government
what's
actually
a billion
issues.
in relation to the total money?
The last time I looked, the last time they measured M3, I think it came up to 13 trillion. Or maybe it's 14 trillion. I mean, they're now...
So 13 trillion is
they don't
a good
report
estimate.
it anymore.
Okay,
yeah.
An okay estimate of what the total amount of money in America might be.
Yeah, or say 14 trillion. That's what the federal debt is. So the federal debt actually is the federal money supply.
Okay, so there's 1 billion, which you're saying is coins. Mm-hmm. How much does the Federal Reserve create?
Well, it used to be a very small, the two of them together was like 3% of the money supply.
Right, okay.
But now the Federal Reserve has gotten into this quantitative easing. So now they've got 2 trillion more out there that wasn't there before. Yeah. But even so, that's only
so it's a fraction.
It's
very much a minor compared to the total money.
Yeah.
And the rest of it, for simplicity, is all the bank created money.
Yeah.
Okay. And so what you're saying is there's you described a process where the banks lend to each other, but the end result is that through this lending process, the actual money is being double accounted and multiplied again. And
yeah, the way it's double accounted is that when you put your money in the bank, it's always there for you to get. They never say, sorry, we just lent your money to Mr. Smith, come back in 30 years. It's always there. But meanwhile, they lent the same money to Mr. Smith. So that's how they've double counted.
Okay.
So they're always shifting. They need the reserves, they need the deposits to back their checks, but they can pull from here, pull from there. They don't have to pull from any, it's just a pool. And so they're using the same pool for two different things.
Okay. So while most of us would think, very normal assumption to make, that all that money is created by some kind of government organization or independent party that works alongside the government to create that money. You're saying that the government, in fact, or a body of the government only in fact creates the coins, which is a tiny percentage of the money. And then we have the Federal Reserve, which most people would assume is some kind of department that's related to the government. But you're saying that that's actually a cartel of private banks, and so it's private, essentially?
Well, you can see it both ways, that the Federal Reserve now is sort of a captive of the government, because ever since the 1960s, when it was first set up, the Federal Reserve actually charged interest on this money that they created and lent to the government. And in the 1960s, Wright Patman, who was then head of the House Banking and Currency Committee, saw what they were up to and said, you all are creating our money and charging interest on it, and that's not right. You should be nationalized.
Okay.
And to avoid being nationalized, they agreed to rebate their profits to the government after deducting their costs. So in that sense, when the Federal Reserve buys government securities, that is the cheapest way the government can get money. And one assumes that they're all talking and that they have to coordinate their policies. And if the government wants the Federal Reserve to buy some securities, that probably happens.
Okay. And then the vast majority of money is privately created through an ordinary bank that me and you use. That we, if I want to come along and take out a mortgage, is the bank created that money?
It has, yeah.
Okay.
So they just, if you want a $500,000 mortgage, or pounds or whatever, they just write that into your account. But then when you'll write your check to your seller, and that'll go into the seller's account. And at that point, the bank has to get the money in somehow. So in that sense, they haven't created it. I mean, they have and they haven't. They still have to borrow it. So that's why you can have bank runs and liquidity crises and all these things, even though it looks like the bank has a lot of leverage to create money.